welcome everyone to Innovation and Expansion Beyond Your Original Business Plan. Thank you for spending the last session of the conference with us this afternoon. We know we're keeping you between the beautiful day outside and cocktail hour coming up for the beach party, so thank you, and we'll try to make it as entertaining as possible. I'm Anne Marie Toll, and I'm with the JLT Insurance Management and the captive practice leader there, and I have two esteemed individuals here with me today speaking on the panel and sharing their expertise, and I'll let each of them introduce themselves. Sean and Mike. Go ahead, Sean.
Hi, good afternoon. My name is Sean Logue. I work for the Risk Management Foundation, which is part of the CRECO insurance program. I work as an assistant vice president in the finance department. I've been there for a little over 8 years. I have an insurance background, so happy to talk to you about kind of the CRECO experience. We've been around for quite a bit, so we've gone through some changes, a few metamorphoses, so I'm happy to share that experience.
Thank you.
Good afternoon. My name is Mike Meehan. I'm a consultant with Milliman. Milliman's a firm of actuaries and consultants. I've been with Milliman about 25 years or so, and I work from the Boston office and specialize in alternative risk financing vehicles, so specifically self-insurance groups and applicably today, captives. Thank you.
Perfect. Well, we'll go ahead and get started. We really encourage all of you to ask questions and make this as interactive as possible. We want the messaging and the information we share to be very meaningful for you. So if you have questions, please interrupt, raise your hand, and we'll be sure to respond to them. Here's a brief agenda of what we want to cover today. Our slides are not very intensive as far as an enormous amount of information. Our content and messaging today is really intended to be more of sharing experiences, sharing what we've seen, what are some of the best practices, and of course Sean has a lot of experience as a captive owner, so we want to make sure that his story is been shared with you, and as I mentioned, feel free to answer or ask questions. So we're going to talk and kick it off really with remembering and going back to creating your original business plan. And from there, what we want to do is talk about Sean's story, and then Mike and I have some other experiences that we can share with you. And then from there, how do you go about and what do you need to do if you're going to make a business plan change? When is it necessary? How do you innovate? What do you need to be thinking about? And all the complexities around the insurance market and the captive insurance market. And then wrap up and talk a little bit as we move through the information regarding some of the actuarial support that is definitely necessary as you make business plan changes. So we'll go ahead and get started. So when we step back, before we get into the meat of the presentation today, think about when you first established a captive. For those in the room, can you raise your hand if you have an existing captive? Oh, great. We've got a good showing. Captive owners, thank you for attending. So thinking back, and depending on how long you've had your structure, you created an initial business plan. When you established that business plan, it was, number one, required by the domicile that you selected. So as you evaluate and go through the business plan, there are a lot of different components that were necessary and needed to be included. Some of it's the actuarial support I mentioned that Mike gets keenly involved with. Some of it's just required by the regulators to understand what type of business you're writing. And then you also need it from a documentation standpoint, whether you're dealing with a U.S. company or if you're in another country, and taking advantage of some of the various tax benefits. So documentation. But what's also helpful with that business plan, and as you work through the actuarial analysis, is working with the markets. So looking at, do you require fronting? Do you require some reinsurance? So there are a lot of pieces and components that your various service providers and partners want to understand about that business plan. So for instance, if you're a healthcare system, you're looking to write medical malpractice, what do you need to include? What do they want to understand? They want to understand your limits. What states are you writing business in? And so all of this comes together, and then looking at how much are you going to retain in the captive. So that entire business plan really is the living, breathing document that supports the program. But it shouldn't also be just in the beginning. It needs to be ongoing as your organizational change happens. What do you need to do to expand or contract as necessary? And we're going to spend some time today talking about what influences and what type of challenges Sean has experienced with their particular program, and thinking about how do some of these components impact their organization on a year-to-year basis. So thinking about what other documentation do you require, how do your partners change over time with reinsurance, because it can change over time if you access reinsurance, but also looking at how are the regulators comfortable with your program. Do they provide some recommendations for changes? And that can be an evolution, so thinking about that process. But just wanted to step back for a moment about going back and creating that original business plan. That's not something that should stop year one. It should be continuing evolution and thinking about what have we done to change, what do we need to do to change to address additional exposures we might have, and how can we take what I call a more captive-centric approach and be innovative with the different coverages that we want to offer through our captive.
Yeah, and if I could just add, I think one thing Anne Marie mentioned earlier when we were talking is the business plan should be kind of a living and breathing document. And our program has been around for a while, and I think we changed our partner providers here on the island not too long ago, and when we did this, we found that our business plan had become kind of stale and a little out of date. So it was a lot of work to kind of get it up to speed, and that proved to be very helpful because our owners have expanded in recent years into new locations, and it's required us to utilize the business plan to go to these new states where the regulators want to know more about us. We've been in Vermont or in the Cayman Islands for a long time, so it hasn't been as important. But now when we're going to different places, they're like, well, tell us about yourself, and to have an up-to-date business plan is very helpful.
Yeah. And I would add to that, a captive is viewed or should be viewed as really a long-term project. So, when the original business plan is created, it's created with an organization's risk philosophy at that point in time. So as I think as we go through the presentation today, you'll see that as companies grow and change, their risk philosophy changes as well. And that's really the reason it's important to continually evaluate your business plan and see if there's new opportunities. And I guess those opportunities don't necessarily mean you're adding things. You could be contracting things as well. And we'll talk a little bit about that later on. But I think that the key takeaway at this point is, it's a starting point and not a finishing point.
Right, and I think that's a good point because you mentioned your organization changes. Even the individuals and the people responsible for the captive can change over time. So when you have somebody who has longevity and the history with the organization, and you're going to talk a little bit, Sean, about how your organization and how long it's been in business here in Cayman, and then the other structures, that's important because you weren't there in the beginning, so you coming into the organization and how much you have an impact too with your thoughts, your beliefs, and how it might interact and generating new ideas, I think is very important.
Yeah. Just one more point from my end before we move on. We have, I think, well-developed strategic goals and objectives, program goals and objectives, and it really helps to have those and tie those back to your business plan so that you have kind of a roadmap as to how are we doing on some levels financially or whatever in order to achieving those goals. So I would try and say, make sure that those are in alignment.
Right, I think that's very important. So Sean, can you share with us a little bit of your structure, what you've done and what you're considering? And we're going to incorporate all of those questions today, but if you, I think, give a little bit of groundwork. Yep. and lay the case study here.
Sure. So it's Thursday afternoon, so there's a whole bunch of us Criconians running around, so I'm sure most of you have maybe had an opportunity to run into us, so you have heard a little bit about the Crico story. So Crico is an insurance program. It's a group of companies that's owned by, and we serve the Harvard medical community. So we are the medical malpractice provider for all of the hospitals in Boston that are affiliated with Harvard Medical School. We have 10 shareholders. We were formed in 1976 here in the Cayman Islands. We currently insure over 13,000 physicians, over 20 hospitals. In terms of the number of employees that are in our system that we cover, there's over 100,000 employees. So we have a lot of history and longevity. As Anne-Marie mentioned, the program was founded in 1976, which is a year after I was born. So it's undergone a lot of changes and history that I am not even familiar with. One plug I would make is in the most recent publication for Captive Insight. One of our founding architects, David Whitefield, who's our resident director here, wrote an article about the history of the history of CRICO in the Cayman Islands, 41 years. So if you're flying back in the next couple of days and you want to have a little light reading, I would recommend it. But he's going to be able to talk about things that I don't even know about. So.
Right. And I think that's nice with the history because you go through different reiterations, especially over 41 years, that people change, the organizations change. You're much larger today than you were 40 years ago. So how do you address all those different exposures and thinking about some of the things you've done, which I think leads to where are you today and what have you done in that time period?
So I think where we are today and how we look today is probably very different than how we looked 41 years ago. There's three primary organizations that make up the CRICO insurance program. No particular order here. We have a risk retention group in Vermont that was formed in 1995. We have the Controlled Risk Insurance Company Limited here in Cayman. That was the first organization formed in 1976. And then there's the Risk Management Foundation that actually employs me. We are an agent of the shareholders. We were formed in 1979 to take some essential functions, do those onshore, such as claims handling. And then one of the things I think that's somewhat non-traditional is our focus and commitment on things like patient safety. And we've kind of managed that at the Risk Management Foundation over years. And it's been one of the uses of our captive and the capital within the captive to kind of expand in that area. One, because we believe it has long-term benefits for the insurance program, but also because it's the right thing to do.
Right. So thinking about patient safety, and Mike, obviously from an actuarial perspective and looking at loss data and then being proactive, can you talk a little bit about how utilizing that data and then being proactive with an organization like CRICO for 41 years and a lot of history of data?
Yeah, certainly. And actually, one thing I found refreshing too is, Sean and I are both from the Boston area, and he says Harvard, and I say Harvard. He said it, and I picked up on it right away that he uses ours. That's incredible.
I really have to focus.
I try and focus, but I don't have the same focus apparently. But I think it's wonderful when an organization has that sort of history and that sort of data available for the actuaries to perform their tasks. Actuaries, we love numbers, and we're going to get into that a little bit more later on in the presentation, but having that sort of information, tracking that sort of historical information, even if, at one point in time you don't think it's necessary, it could prove fruitful and beneficial down the road as you sort of evaluate new opportunities. So if you were planning to implement some sort of risk management initiative, or you're looking to change limits, all those sort of, or look at new coverages, certainly, having historical information that at one point in time may seem meaningless to you is information that the actuary can certainly rely on. And it helps us rely on companies' own historical information versus having to look outside your organization and look at insurance industry statistics, which may or may not be representative of your organization's sort of loss history. So,
right. And I think the entire risk management process and what you've done with the foundation and supplying those types of services is very meaningful, because I think a lot of organizations, when they first establish their captive, they really want to focus on that risk management and how can we prevent claims from happening. And it's hard, I think, sometimes initially with early captive years and until you're up and running, to really have the applicable data if you've been for instance, with commercial carriers, and you don't have access to all that data, but now that you start to generate your own data, I think that's when you can start making meaningful decisions on here's what we need to do and here's what we need from an impact perspective of preventing claims and then mitigating claims very early on.
And I think, one of the key challenges always is how do you measure that impact, and having, a solid history of data is important. Having actuaries that you work closely with that understand your program, that can actually go in and do that deeper level analysis that's needed, because what is truly impacted by the initiative versus what is either noise or just kind of industry trends in general. So it really helps, I think, to have a solid relationship with your partner providers that are going to be able to go in and do that work on your behalf, and you're just going to get a better product as a result.
Right. And I think oftentimes, those initiatives, there's an expectation on what maybe a risk management initiative is going to generate, how it's going to translate to the bottom line. And it's sort of tough for the actuary to take that at face value and say, we're going to do this, and we expect it's going to lower frequency or severity by 10%. And that's all well and good, and it may actually work out that way. But sometimes you really don't see the benefits of that it doesn't really show up in the information that we get to see for a number of years. And that's where really one of the challenges comes into play.
Right, and I think that's important because, and one of the questions for you, Sean, is do you set any benchmarking, and how do you measure success? Because some of that helps drive that innovation and that expansion, because if you have benchmarks and we want to hit this, this, and this, it does take a little bit of time to be able to measure some of those impactful changes.
Yeah, and I think, so one of the benefits of kind of having a well-established and a well-funded captive program is we can take some risks. We can take some time to really understand whether the initiatives that are put in place work. So we take a much longer-term view, but we also have invested and have an in-house strategies team that has a very large benchmark of nationwide claims data. And so it's not only our data that we're looking at, we're looking nationwide at all of our clients' data. We have access to the information that our actuaries have. So we are trying to benchmark these initiatives across multiple views, right, so we can get a sense as to how are they working. But again, the key thing is sometimes it takes a while.
Right.
Something that's put in place now, you're not going to see the actual impacts for a number of years. So you're going to rely on kind of your best guess initially, what you can afford to kind of risk, and then good partners that can kind of interpolate or extrapolate the data.
Sure, certainly. So when we think about different changes and some of your experiences with what you've gone through in the 8 years you've been with CRICO, and then what you know about some of their prior experiences, just organizational changes, how do you assess what the organization needs, and then have you worked through some of the other types of applicable coverages that might make sense to retain in a captive, and how has it been challenging, or how has the process been fairly smooth?
Yeah, I think what's interesting is in my time, compared to 8 years ago, is the level of sophistication that has come to how we approach the business. Whether it's the evaluation of new coverages, it's the analysis of how we structure the reinsurance program, the investments that we'll make towards giving money back for capital management, or patient safety initiatives. There is a level of rigor now that has increased so much over the last 8 years. And I think in order to kind of match or rise to the level, we have had a focus on data analytics, especially recently, in order to be better, make better decisions. So if there's the wealth of information, how can we mine and utilize that information? And in order to do that, we've had to make sure that we have a solid path and plan in place in order to meet that.
Sure, and I think that's important. I actually was at another conference several months ago, NARA, which is a risk retention group focused, and they were talking with the reinsurance companies about the level of analytics and what they're providing to their clients now, because it is important, and the level of sophistication and what people are searching for, because then they can make a decision on, can we restructure in a unique way with our reinsurers and take a little different approach. Maybe you didn't participate at a higher level. Maybe the organization wants to participate now. And how can we utilize the data and then even the wider data from other organizations? I think that's extremely important. So,
And I
go
think,
ahead.
just moving along, some of that is dictated based upon changes that are happening in the environment. And, we're always focused not only on kind of what's going on in the insurance marketplace, but what's happening in the healthcare marketplace as well. I don't think for anyone here it'd be any surprise to say that there's a lot of change going on in healthcare. A lot of the systems are feeling it economically, and as a captive providing them with their medical malpractice amongst other coverages, we need to be ready to be able to respond to their needs and concerns. So it's a focus on what's going on in the insurance marketplace, for which we're kind of operating, but what's also happening with our shareholder insurance.
Right. And have you had, and you might not know this answer, but have you had any pushback? Because I know obviously medical malpractice has been fairly cost effective the last bit of time, 10 plus years, but at different times there's been a harder market and it's been more challenging. Have you had any pushback, or what's your experience with trying to keep premiums steady, and how have you adjusted and flexed over time?
Yes, so we have well documented and articulated program goals and objectives that lay out, and we have broad approval for this, that over time, one of our goals is to provide our members with stable premium rates. They don't want volatility from one year to the next. We're explicit in how the premium rates are set, and that we're not adding in explicit risk margin or profit loads, that we are going to run the business, at least the underwriting side, at as close to break even over a longer term basis as we can. So in order to do that, we need to have kind of a strong balance sheet to support it. But it's one of those things where we work with them in advance to make sure that we have their buy-in, and then we manage the program to those goals and objectives.
And just to interject, that's an interesting point, that your approach now is to fund it to the expected level, basically, because from an actuarial perspective, expected means you could 50-50 chance essentially that you could be better or worse than that loss pick. And when a company's got that sort of history where they've been successful and they've developed some surplus, it allows them that sort of flexibility, whereas a less mature program that has basically their initial startup capital in there really can't take the same risk. You can't run the risk of having to dip into that initial capital year one, or it does happen from time to time, but that's really not the ideal situation. So it's when you have a really strong program that's proven profitable early on, it allows you to be a little bit more creative going forward.
Right.
And to one of your other points, Emery, the current market, because we're not chasing the commercial market providers up or down, we're trying to be stable, we're trying to fund to what our actuaries are telling us are our expected losses. There are times, and now is one of those times, where often, our premiums or our pricing might not be the cheapest. And again, we're over the long term, if we can provide stability, ultimately that's what our shareholders are looking for, and I think that's what kind of gets us through these situations where right now there are other providers out there that can go lower than where we would like to be or willing to be.
Right. And I think some of the other conditions, when we think about what happens with the markets over time, right now we've obviously had some very catastrophic weather events, obviously, that will come through and probably have some increases, at least on the property side, and may have a trickle effect as we move into 2018, depending what happens with worldwide events. So I think as we look to 2018 and 19, could it have a trickle effect? And do you think there are areas that would impact, whether it's the medical malpractice or any of the other lines of coverage, or would you start evaluating and looking at some of the wider coverage areas as a result of it? And then same thing in the U.S. in particular, the healthcare costs, the ACA, and everything that's happening right now with Congress. How will that have an impact to you?
Yeah, so I mean, speaking on the reinsurance side, we're a relationship-driven business, and we have our partners that are reinsurers that we've been with for a very long time. We have an understanding of what's going on and the pressures that they're facing and what we might be looking at. But given that, we're in it for the longer term, there are years where, the wind's going to blow and it's going to have an impact, and we're not looking to walk away from our providers, but they also understand us pretty well. Over time, we've worked closely with our reinsurance brokers to develop a system or a structure that kind of weathers these changes in the market pretty well. Some of that involves utilizing our own capital in order to kind of take on maybe a bigger retention.
Right.
But it's allowed us to kind of have a program that doesn't really swing wildly from one year to the next. So we're really, that's something that we focused on and really happy with. I don't know, Mike, if you have any thoughts on some of the other.
No, I mean, I guess, from a captive utilization standpoint, I mean, I think, if you look back over time, you can see, clear and discernible patterns when there's been, hard markets in certain lines of coverage. There's been sort of a sudden increase or spike in either captive formations or changes in business plans. So it could be medical malpractice in the 80s. Certainly after 9/11, there was a lot of, market adjustments there as well. This year, I expect there to be, a lot of folks looking at the property coverage and expanding their business plan. I guess I wouldn't necessarily expect there to be a lot of new formations around just a property coverage. It could happen, but I think time will tell. At the beginning of the year, when people start getting their renewals, or they've probably started experiencing them now, when you're getting close to double-digit rate increases, people are going to start to take a look and see if it makes sense to include property. Similar to the last couple of years, health coverage. Folks are taking a little bit, a layer of the medical stop loss in their captive. So they're finding new and creative ways to utilize their captive in a direct reaction to what's going on in the marketplace.
Right. So thinking about all that and the market changes, and when we look at some of the other components here on this slide, when you have collected the data, you've gone through the analysis, which we'll talk about in a moment, how do you go about the process of deciding, okay, we're going to make a business plan change, and in your particular case, it's more of what we'd call a group, and you have members. So it's not a single parent captive here that we're discussing where we're going to make the decisions just for our organization alone.
Right.
So I'm sure that becomes more challenging.
I think for us as a group captive, it does add another element or another level of challenge, because when we introduce a new line of coverage or something that would necessitate a change in the business plan, we have to figure out what's going to work for all of the shareholders. We don't really want to have kind of this one-off for this member and then something slightly different. We want to be able to provide something that is going to give them what they need, but also, be kind of some efficiencies there.
Correct.
So it takes a little bit more time, I would say, because we want to get buy-in. And I think when we've been successful with introducing new coverages or changes to the structure, it's because there's been buy-in, and sometimes that means a lot of analysis around why this coverage in the captive makes sense. It helps if there is some actual claims or loss experience that we can point to. So sometimes it helps working with the actuary to bring to their attention some of the things that maybe they haven't experienced yet, but the potential exposure that's out there. So I would say it is a little bit more challenging. At least my perspective is it's a little bit more challenging, and it takes more time and just more effort.
Right. So you need to make sure you build in additional time, because it's not as if your board can immediately decide and have an impactful change immediately.
Right. And then I think too, as a group, we've focused primarily on the medical professional liability, and we've added coverages over time. But each of our shareholders have their own insurance offices that are responsible for placing all of the other coverages that they don't get through the captive. So there's also a certain amount of competition, so to speak, if we're thinking of introducing something in the captive that they're already placing them, there's a little bit of a tension there that we sometimes have to work through as well.
Right, which makes sense. Anytime you have a group captive with members, and where do they want to place their business? So just thinking about that. So when you think about your experience and some of the business plan changes, and I know you've done a recent update, how comfortable are you, or who do you seek advice from in making those decisions? I know you've talked about the actuarial analysis, but making sure that it's properly documented, you've communicated with your domicile, whether it's Cayman or Vermont,
Yep.
and working through that.
So first, once you have the approval and buy-in from the board, we kind of throw it over the fence to our insurance managers, and they do a fantastic job. But we need their assistance and their input, because we can kind of tell them what it is we want to do, and they're going to tell us, okay, this is what you need, this is how we should document, and they're going to, basically, sometimes we think we know what we want, but we don't know everything, and seeking input from our partner providers is going to lead to having a better product. And again, we rely heavily on our external expertise, because it's not as straightforward, so it helps to have expert guidance.
Right, it makes sense. So thinking back about your 40 years of innovation, do you want to touch on a couple of different key points throughout your history here?
Yeah, I mean, again, I would just say, as I mentioned earlier, the Crico today is very different than the Crico of 1976, except for that we're still true, I think we still hold true to our original mission, to protect our providers and promote patient safety. Over time, we've added coverages. Our medical professional liability is still our primary coverage, but we've added in different coverages. In 1991, we added association liability, which is essentially directors and officers and employment practice. We've added international coverages. One of the things I think that's a little bit of a non-traditional use of the captive has been our focus and commitment, as I mentioned earlier, to patient safety, whether that's funding initiatives, simulations that have led to dramatic improvements in the loss experience across multiple specialties. Initially in anesthesia and OB, now we're seeing the effects in surgery. So this has required focus, time, and money, and it's one of the things that we have been committed to over time, and it's worked out both because it's the right thing to do, but it's also lowered loss costs for the members.
Right, it makes sense. I think that's part of the overall arching motivation, is to continue to drive down those loss costs and the patient safety, which is ultimately the most important. So when we think about some of the benefits and challenges, we've touched on a few of these, but I think what organizations always consider and think about, whether you're establishing a captive or you're looking to innovate and expand, the competing uses of capital, whether it's the capital that's already in the captive or capital that would be at a parent company or the member companies. How do you address that? How do you handle that?
So for us recently, it's been around investing a lot of time around becoming more sophisticated with our capital governance and our risk modeling to determine or better assess what is the right amount of capital to hold within the captive, given the risks that we're undertaking or what risks might be coming down the pike, so to speak.
Right.
So that provides kind of a benchmark for, given what level of confidence we want to be that we will always be able to pay claims, how much capital should the captive hold. Then if we're in a position, which we fortunately have been in, that there's been capital above that, what is the best thing to do with that capital? Right. And again, we might have lots of different ideas around different coverages, additional patient safety investments, but given the environment, the members might also have their own ideas, which could be a kind of a cash distribution back.
Correct. Yeah, how do you balance that with your members on, look, we see the balance sheet and there's an enormous amount of capital there. Could we have a reduction or could we have a distribution? Because I think that's always the challenge with group captives.
I think having a well-documented and agreed-to governance process helps, because then you know what the rules are going into those conversations. At the end of the day, it's the shareholders' company. Sometimes there's not agreement amongst the shareholders as to what the right path forward is.
Oh, sure.
But it's always a very engaging conversation when there's money on the line. So.
Right.
Yeah, I would echo that. It's important to have that established and very clear up front. We've seen occasions where when it comes down to money, people are very sensitive, and as they should be. But ultimately, the amount of money that's going to remain in the captive, you do have that discussion with your regulator as well, because they're gonna want to know if you're going to be releasing some capital. But, in cases where, say, a member is going to leave the group, want to be very clear up front on what is their stake, what do they get to take with them, if anything. If you leave, are you leaving all the capital or the surplus that you've built up in there? Does it stay there and you have no right to claim for that? So, all those sorts of things are important to get clear and very clear right up front to avoid any issues down the line.
Right, I think that makes sense. And then, of course, some of the benefits that can be reaped by innovating and expanding your business plan can range anything from, and you don't necessarily do this, but people look to, in their control group of affiliated companies or controlled relationships, are there opportunities to offer a solution that would be beneficial to that relationship? So we've seen situations where there's been expansion for vendor liability programs because the vendors you're working with or your subcontractors, whatever it may be, just don't have the applicable limits that you require. So there are opportunities to solidify and expand relationships, but also utilize your captive to offer a solution that is comfortable to them, but also makes you comfortable to have that insurance in place. So you think about a lot of different areas, and Mike and I have both seen a lot of different plans, so thinking about how do people innovate and expand, and some of it's looking internally at their own corporate risk, but also external environmental factors, what type of relationships, what do they have, that I think are very appropriate and could be evaluated for expansion.
Yeah, and we'll talk a little bit more, I guess, about some of the challenges on this page here. When we get into a group program, it's a lot more complicated. I've always used the analogy, it's herding cats, because particularly when you're talking about expanding your business plan to include a new line of coverage. When you're doing a feasibility study for a group, it's interesting. The groups come together and the members have decided they're thinking about going into business together, but they still don't want to share their data with anybody else in the group. They want to still have that sort of confidentiality. So that's a challenge in and of itself. And you're trying to herd cats now and gather this information from 5, 10, 25 sources versus one where you've got a single parent, where it's much more easy to sort of gather that information.
Yeah, and I think our experience has been since the founding days, our members have been willing to work together in areas around that improve patient safety. So they're willing to engage in conversations, talk about things that will lead to improvement, which I think has been kind of a key driver of success and why the program has lasted as long as it has. When we start to talk about adding something new, there isn't as much, or it's slower to materialize, engagement around some of these things. We talk about cyber liability a lot, and it's one of those coverages where we've done some work that necessarily we haven't really launched within the captive, and maybe some of that is because there's a bit of a tension amongst the owners to get to engage in conversations with one another around maybe perceived deficiencies or weaknesses within their programs.
Correct. And I think that's an important point, particularly on cyber, because in the healthcare arena, there are more unfortunate opportunities to pierce that data and that patient information. And so trying to make sure that, do you open the kimono per se and say, here's our system, here's what's happening, and sharing that data can be a bit challenging.
Right, and I think it goes, a little beyond that in terms of, if you decide to insure a coverage like cyber, now you've got to make sure that you're going to be insuring this line of business with other organizations that may not share the same sort of risk management philosophy with regards to that exposure that your organization does. So that's a challenge too. I mean, it sounds like in your case you've got this sort of patient safety first sort of attitude, and now it's and that common sort of goal has helped your captive evolve and grow and be successful. And the question is whether or not that's applicable to a new line like cyber. Do you have those sort of share those same common goals and attitudes toward that?
Right. So thinking about typical business plan changes and some of the opportunities that you've had over time, there are obviously straightforward, simple ones, changing limits. For instance, we were talking earlier about venturing into new states.
Right.
So when you're venturing into a new state, how do you handle that? What are the limits? And do they have tort reform or not? So there's a variety of different state by state law that you need to address and handle, because that is a business plan change with your domicile. On, you know, if your current limits are 1.3, but you now want to offer 5.10, you've got to make sure that the regulators are on board with it, your actuary's on board, and you've done the analysis for any additional exposure. So thinking about changes of limits, lines of coverage, your reinsurance partners, and then the next step is really evaluating, do we just add something new, as you gave with the cyber? And it's a longer process. It's going back and stepping back. When we had the chart on the first page, it's almost going through a re-feasibility analysis each time you evaluate a change to your program.
Right.
Because each of those trigger points are changing.
Right, and for us, you know, our recent experience has been, while we're you know, a hospital company, you know, our shareholders are our policyholders, given some of the unique characteristics of Massachusetts, we act like a physician company. As our members have expanded outside of Massachusetts, we've had to kind of learn to become much more of a traditional hospital underwriter, which has led to, you know, changes into the policy, the coverage that we provide, the limits, the claims, how they are handled differently. Are they handled differently? A lot of learning, and that has necessitated involvement with our actuaries in order to understand what is it like in different places. What is hospital business like, and how is it priced differently than physician business? With our insurance managers, to make sure that we're actually, you know, able to do business in these other states. So it does. You know, it's it truly takes a village.
It does, absolutely. And then I think the other expansion opportunity for innovation is really looking at, do you have new ventures? Do you have partnerships? Do you have acquisitions? What has changed? And really taking a look at that captive-centric approach and how can the captive step in, particularly with the philosophy, as you mentioned, with that patient safety. Do you have joint ventures or other partnerships that it makes sense to share those risk management practices and bring them into the fold?
Yeah, and I think those conversations are easier to have, especially if as we as a group captive have that strong balance sheet that is available to take in additional risk or exposure.
Right, makes sense. Mike, do you want to talk a little bit about the actuarial support and what's required? I know you've touched on some of it, but obviously
Sure.
this is a pretty labor-intensive process as you evaluate all of these types of changes.
Certainly, yeah, and I, on the previous slide, I mentioned, you know, changes due to changes in the market conditions with regards to limits, and I just wanted to point out, it doesn't always mean you're taking on more risk. You know, there's been periods of time, cycles in the insurance market where the prices of reinsurance have come down significantly, and it makes more sense for folks to actually lower the limits that they're putting to the captive because they're getting a much better deal in the reinsurance marketplace. So I just wanted to be clear and touch on that, because I think sometimes folks think, you know, changing limits means we're going to take on more risk, and it doesn't necessarily mean that. And I think, you know, captives need to be aware that there are other opportunities that may be somewhat counterintuitive. But when it comes down to actually doing the analysis, for all of you that have an existing captive now, you went through that initial captive feasibility study phase. And it was probably labor intensive on your end to gather the information. I touched on earlier, you know, group programs versus single parent programs. But basically you're going through and gathering up the historical information for the actuaries to provide their loss or estimate their loss projections. So anytime you're going to be making a business plan change, it's a very similar sort of exercise. If you're making a change to an existing line of coverage, then the likelihood is that you've already got that information. The actuary likely already has the information. So you can really take a good long look at those and evaluate those limits without it being too painful, I guess, on your end. When you start thinking about new lines of coverage or adding in new members where there may or may not be historical information available, that's when the challenge begins. So, you know, if you were historically buying coverage in the commercial market, then you can go to your carrier and you can get that historical loss information. If it's a coverage that you were previously, you know, not insuring, you were self-insuring it, you just didn't know it, or you're acquiring a new business, you know, then the challenge is a little bit different. So if you don't have that sort of loss history, you know, as you're probably aware that, you know, actuaries rely in the past to predict the future. So to the extent that it makes sense to do so, they're going to want to take a look at that past. And when the past isn't available, that's a challenge. So, at that point, the actuary needs to start looking at external sources, industry sources, which I think I mentioned earlier may or may not be representative of how your organization's loss history is going to behave. But, it's important to have that dialogue to make sure the actuary understands exactly what it is you're trying to insure, what the challenges are, what sort of loss experience, what do you envision as being a loss driver in that line of coverage. And then it takes on the same sort of form now as the feasibility study. The regulator is going to want to have that loss pick. In all likelihood, the regulator is going to want to see some pro forma financial projections. They're going to want to see, are you putting your balance sheet at risk now by taking on this new risk or expanding your limits? They want to, at the end of the day, the regulator wants to make sure there's enough money to pay claims. That's really what we're in the business of, and they certainly don't want to see a company become insolvent due to a change in their business plan. So it's the same sort of intensive type of analysis that you see at the feasibility study stage. The regulator is going to want to see some expected cases on the pro formas. They're likely going to want to see an adverse scenario as well, just like during the feasibility study. Because again, they want to understand and see that the captive is going to be able to respond if things were worse than expected in year 1, year 3, whether it be due to a single catastrophic claim or worse than expected loss experience due to a frequency issue. So it's a very similar sort of process in terms of data gathering, in terms of actuarial analysis, and in terms of preparing that presentation for the regulator to evaluate whether or not they're going to approve that business plan change.
Right. No, I think that's all important, and you've obviously gone through several of the reiterations with different lines of coverage. You added the Vermont Risk Retention Group, so I think that's a good example that just because you set up one captive doesn't mean you're limited to one captive. And you're looking at different domiciles because there are various reasons why it could be cost effective, access, direct access, whatever it may be. So consider those different components that what you set up today and innovating, you could convert tomorrow to a protected cell, segregated cell, because you might have opportunities to segregate the risk for a variety of reasons or offer it to other people. Right. So I think when you look at, and going back just at your history, that I think you've demonstrated, okay, here's what we've done. We have changed pretty dramatically in the 41 years we've been in business, and probably the next 40 years will be a dramatic difference from where you are and exist today, because all of those different components that we've talked about have a very big influence on how you make changes and how do you address exposures for your organization.
Yeah. And I think, as the world continues to evolve, there's always new and exciting things that can be done. And, you know what you know, but you don't know what you don't know. So it helps to have, good contacts and good relationships, that people that can understand what your situation is and can help you come up with some of these structural changes that will address those issues going forward.
Right. So I think we've presented quite a bit of information today, and we don't want to hold you up, of course, from the beach party here later, but want to open the floor up for questions. Oh, sorry, go ahead. Ray.
Have you looked at providing health insurance for your employees through your captive? We do MedMal. I feel we've had a good risk control on MedMal, but it's like a crapshoot with health insurance, but it's one of our largest variants in expense within our corporations that own the captive. Is there any guidance on here?
So that hasn't been an area of focus for us. We have talked about medical stop loss in the captive. It's more surface level conversations, but the employee healthcare, no, that's not something that has risen to something that would make sense given our structure.
Right. I think both Mike and I have worked with companies that have, with single parent captives or group captives, they're writing traditional lines, whether it's medical malpractice, workers' comp, general liability. And I'd say in the last 5 to 10 years, a lot more of them are starting to take that cost and risk into the captive. And part of it is a hard, and Mike can speak to this, because there's more volatility. Some of it you cannot control. You can't control who's going to get cancer. I mean, you can't control. Some of it you can change behavior and be proactive from a wellness perspective, but there are some that you can't control. So how do you balance that, and how do you evaluate? And Mike can certainly speak to that from an actuarial perspective.
Yeah, I mean, I guess, that's certainly one of the challenges. I would say in the last, as you mentioned, 5 to 10 years, I'd say really for us, the last 5 years or so, there's definitely been a significant uptick with companies at least kicking the tires on evaluating, some sort of layer in the medical stop loss and running that through the captive. But, it's a volatile line, and they're not willing to risk their balance sheet because of those potential catastrophic claims. I mean, the same, it still holds true. You retain the predictable, and you send to the insurance commercial market the unpredictable. So I think it holds true in medical employee costs as well. So,
Right.
you're welcome.
Any other questions? Go ahead.
Yeah, okay, so this is a little bit of a different take, but you're talking about capital, and, how your members are very focused on that, particularly dividend out and that kind of thing. But, the flip side of that is, if you look for a large group captive and sophisticated captive, or sophisticated members like you have, what do you do on the investment side? Do you have like a separate investment committee?
We do. We have kind of we have a very well-developed committee and board structure. We have a separate committee that focuses on investments, and as the program has grown over time, the investments have become more complex, and it's been to our benefit, as investments have been one of the primary drivers of our capital growth over the years. But it does require a different level of focus and attention now. So there's a certain level of sophistication of the individuals who sit on that committee that they can provide that expertise.
And how many of those members of the investment committee are actually on your group captain board?
On the investment committee, we have 2 or 3 members that are board members, I believe. On the investment committee probably has maybe 10 or 12 members.
That makes sense. Okay, thanks.
Good. Great question. Any other questions? Well, good. We don't want to hold you up anymore. I do want to thank my fellow panelists for their time and expertise shared today, and thank you all for attending.